Okay, thank you so much for everybody, to everybody for joining us today. We're going to start the program. So I'm going to invite Jenny Udanin, who's the chair of the Jewish Community Foundation's Professional Advisors Network, to say a few words.
Hi, thanks for the introduction, Yafa. As Yafa said, I'm Jenny Udanin. I'm the chairperson of the Professional Advisor Network at the Jewish Community Foundation of Greater Metro West. I want to thank you for joining this third webinar in our educational series. We are proud to be here always as a resource to our professional community during this very unusual time. If there are any topics that you would be interested in learning more about, please reach out and we will try to arrange a webinar on one or more of those topics. I want to thank our presenters today, Jerry Diener of Fox Rothschild and Anita Siegel of Siegel and Bergman, for taking the time and making the effort to create this webinar. I also want to thank our moderator, Tamar Warburg, who is the General Counsel at the Jewish Community Foundation. And with that, I'm going to turn it over to Tamar and our panel to proceed with the webinar. Thanks.
Hi, everyone. Thank you so much for joining. I'm Tamar, I'm General Counsel at JCF, and it's really a pleasure to be sort of moderating this discussion. I came to JCF about 9 months ago. I think it's 9 months, and before that practiced estate planning for about 11 years. So it's a lot of fun to be on the other end today. Just a quick note, if you have any questions, as Yafa mentioned, if you have any questions during the presentation, use either the Q&A or chat feature at the bottom of your screen. We'll collect the questions. Only the panelists see them. We'll collect them and address them at the end. And I know there are a lot of estate planning attorneys on this call. By the same token, there are plenty of others on the call also. So don't be afraid to ask any questions, no matter how simple you think it is. Chances are if you have that question, someone else does. By the same token, we have Anita Siegel and Jerry Diener, so you don't have to be afraid to ask any tough questions either. So without further ado, I'll turn it over to Jerry, who will give us an introduction to our estate making lemonade out of lemonades program. Thanks. So Jerry, you're muted. You can go ahead.
Hear me?
We can hear you.
Okay. First, it's a pleasure to be here. I want to thank the people at Federation for asking us to do this. We always enjoy, partaking with other professionals, and we look forward to a good give and take at the end. We have the opportunity to ask some questions. So the title to this event is it was supposed to be the perfect storm, but we made it even more sexy to make not just lemonade, but spiked lemonade in the current economy. Now, why is that? All right. Number one, I've been doing this for more than 1 or 2 years, and I just can't remember any time since I've been practicing where you have a triumvirate of low values. It was low values. I'll call them uncertain values right now, and it's still probably low real estate values and low business values, where you've got low interest rates, you've got a high exemption that's around for just another couple of years, and if there's a political change, and Anita's going to get into it, the exemption could drastically reduce. Furthermore, a lot of what we're going to be talking about today are good estate planning opportunities under current law. There's a lot of talk, especially by the Democrat end of things, that if there's a change in congressional seats and a change in the administration, the likelihood is that a lot of what we're talking about today may not be available in the future. I think we said Anita is going to lead off with some highlights of the Secure Act, which is another A lot of people call it just a lemon. I don't know, Anita, maybe you can make a lemonade and a spiked lemonade out of the Secure Act. I'm sure you can. So why don't you take it away?
Okay, good afternoon, everyone. So what's going on with our retirement benefits now, and what can we do about it? Because there have been some real changes. We're going to talk now about the Secure Act as it applies to IRAs, 401k plans, qualified retirement savings plans, and similar plans, but not pension plans, because that's where the real changes are, is with the IRAs, 401ks, and other qualified plans, not pensions. So first we got the Secure Act back in December, and it had some real significant changes, and it was quickly followed by the CARES Act in 2020. So we're going to look at what happened. Well, prior to 2020, if I had somebody getting benefits from me, if I died before 2020, there were some wonderful choices. And one of those choices for a spouse, there's really very little change. But for other than a spouse, whether it was my child, my sibling, niece or nephew, or anybody else, they had the ability to spread that out over their lifetime. And if I was leaving it to my 40-year-old child, it meant that they could take it over the next 45 years and really spread out that value, pay the income tax over all those years. That was wonderful. And a conduit trust, if we didn't want them to spend it all at once, we could spread it out over those 45 years. It was a wonderful thing. But then Secure Act came in, and it said, no, that's a little too rich. Now you're going to have 10 years to get it out. That's it. And so all of a sudden, where we had that great spread of the benefits and therefore the income tax, that was gone. The Secure Act said, no, you can't do that. It's going to be 10 years. Then the CARES Act came in, and it also changed things. But let's go back to the Secure Act for a moment. So an individual now has only 10 years to take it out. And that means by the end of the 10th year after the death of the participant. And that's the general rule now, the 10 years. Now, there are some exceptions to that, and that's for an eligible designated beneficiary, where they can use the life expectancy rule. That's a surviving spouse still, so that hasn't changed. And for a minor child, they can use the life expectancy until they're an adult, and then they get 10 years after that. And of course, there's no definition of an adult yet. A disabled or chronically ill person can take it either directly or through a trust over life expectancy, or a person who's no more than 10 years younger than the participant, maybe a sibling or a friend. The conduit trust is still available, but it has to take it in 10 years. The see-through accumulation trust is still available, but it has to take it within 10 years. And all other trusts have to take it within 5 years. That's a whole lot faster than before. What did the CARES Act do? The CARES Act said, well, for those of you who are in a retirement status, you don't have to take your RMD this year, okay? If you have, next year I'll have to take it again, but I don't have to take it this year. So what did that mean? Somebody who was already in retirement pay status last year, over 70 and a half, starting last year, they don't have to take it this year. And for those who were turning 72 this year, is the new age, they didn't have to take it this year. That hurts us charities because if they didn't have to take their RMD, well, then they might not be so generous to us. However, the other thing the CARE Act did was it said on the limitation on taking charitable deductions, you no longer have a 60% of your adjusted gross income. There's a certain limitation on it, so that you could get a deduction up to your full income. So that encourages people to make charitable gifts. So the Secure Act, which is forcing faster withdrawals, and the CARES Act allowing charitable contributions larger than the 60%, there's an add-on and a subtraction, and it's very confusing. Well, what can we do to help our clients use all these new rules, which are more than a little confusing, and their charitable bent, and help their family and all of this? How can we use the rules of the Secure Act and the CARES Act to help our clients with their charitable giving and really make some lemonade out of all these lemons? let's look at a charitable remainder trust. It's one of my very, very favorite things, okay? Well, what is it? What is a charitable remainder trust? It is an irrevocable trust from which a non-charitable beneficiary, meaning a person, receives a fixed dollar amount called an annuity of not less than 5% nor more than 50% of the initial fair market value of the assets, or a fixed percentage of not less than 5% or not more than 50% of the fair market value of the assets determined every year, distributed at least annually, and upon the death of the income beneficiary getting either the annuity or the unit trust, or after a specified term of years not more than 20, one or more charities receives the leftovers, the remainder of the trust. That kind of trust can be established during the life of the donor or at the death of the donor. The income beneficiary can be the donor, can be the donor's spouse, can be the donor's child or somebody else, can be the donor and spouse. So it can be fairly flexible. What kind of tax benefits do we get here? Well, the key income tax characteristics of a charitable remainder trust are that, first of all, the charitable remainder trust itself is totally exempt from federal income tax. The charitable remainder trust never pays federal income tax on interest it receives, dividends it earns, capital gains it earns, anything earned in the trust. It doesn't pay income tax if it receives IRA money or 401k money. It doesn't pay income tax, federal income tax. Does it pay New Jersey income tax? Maybe. If the trust has a New Jersey trustee, whether that's an individual or a New Jersey bank, it will pay New Jersey income tax and set up by a New Jersey donor. But if it doesn't have a New Jersey trustee, if it doesn't have New Jersey source income, what's New Jersey source income? For example, real estate that has rental income in New Jersey. If it has a New Jersey business, stock of a New Jersey business, an LLC interest in a New Jersey business, that's New Jersey source income. But if our CRUT, call it a CRUT, a charitable remainder trust, if our CRUT is funded with marketable securities, and even if our CRUT has the income beneficiary, the donor, donor spouse, whoever's getting that annuity or unit trust interest, is a New Jersey resident, but the trustee is not a New Jersey bank, is not a New Jersey resident, and is funded with marketable securities, then we don't have to pay New Jersey income tax on the income either. That's pretty good. And so we're doing a lot of trusts with Delaware trustees. And even if our income beneficiary is a New Jersey resident, we're not paying New Jersey income tax either, even on the IRA money. Interesting. Okay. We also have a charitable deduction for income tax purposes. If the donor is setting this CRUT up during donor's lifetime, there is an income tax deduction available for the actuarial value of the remainder that's going to go to the charity many years in the future when the income beneficiary dies or at the end of the 20-year term. So I get a current income tax deduction for the actuarial value of what's going to go to the charity many years in the future, but the income tax deduction I get now. What's the income tax consequence to the income beneficiary? Well, the income beneficiary is getting a distribution from the trust each year. Some or all of that distribution will be income to the beneficiary. It depends on what income was earned in the trust. Remember, the trust isn't paying any income tax, any federal income tax, and maybe not any New Jersey income tax, but there was income earned. And so the income as the distribution as it comes out to the beneficiary may be income taxable to the beneficiary, but never more than the beneficiary receives. So the distribution of the annuity or unit trust to the beneficiary will have a taxable income component to it, all or part, but never more than received. So if that trust received some IRA money, some of that distribution to the beneficiary is probably some of that. All right. What is the gift tax characteristic of a lifetime charitable remainder trust? Well, the gift into the charitable remainder trust actually has two components to it. There's the gift of the income interest, the annuity or unitrust, and there's the gift of the remainder interest. It's a split gift. Well, the income interest is a current gift. If the donor is the one retaining the annuity or unitrust interest, that's the income interest. Well, I can't make a gift to myself. That's not a gift at all. If I am setting it up for my spouse, that's a gift to the spouse, but that's eligible for the marital deduction. So I don't have a gift tax there for my spouse because I get the marital deduction if either the spouse is the only beneficiary or donor and spouse are the only beneficiaries. If I set up my charitable remainder trust for somebody other than myself and my spouse, maybe I set it up for my child, then I've made a gift to my child. But it's a current gift, and therefore it's eligible for the annual exclusion, the $15,000 annual exclusion from the gift tax. So I get the annual exclusion, but if the income interest for that person is larger than the annual exclusion, then it is charged against my lifetime exemption. But as we'll hear later, right now the gift tax lifetime exemption is $11.58 million per person. So if I set up a charitable remainder trust where the lifetime interest to my child is $100,000, I have a $15,000 annual exclusion, and I've used $85,000 of my $11.58 million lifetime exemption charged against my lifetime exemption. I have to file a gift tax return, but I don't owe any gift tax. Then I get to the remainder interest, and the remainder interest, of course, it's going to charity, and it's eligible for the charitable gift tax deduction. I don't pay any gift tax. I may have used a small amount of my lifetime gift tax exemption, but I don't owe any gift tax. Then we go to the estate tax consequence. It depends on whether I set this up during my life or upon my death. If it's a lifetime charitable remainder trust and I retained the income interest, then it's included in my estate under 2036, a retained interest, but it's passing to charity upon my death, estate tax charitable deduction. If it continues for my spouse after my death, that's the marital deduction for the share going to my spouse, and a charitable deduction for the remainder going to the charity. If it's going to somebody other than my spouse, then there is a taxable bequest for the actuarial value of that piece and a charitable estate tax deduction for the piece ultimately going to charity. If I set it up upon my death for my spouse and then charity, marital deduction and charitable deduction combined, no tax. If it's going to somebody other than my spouse, I have a bequest for the actuarial value of that and charitable deduction for the remainder. So it's a wonderful thing. So let's look at an example, and we're going to see how the CRUT and our retirement benefits are perfect together, and this is the lemonade. All right, we have $1 million IRA. I'm setting up a 5% charitable remainder unit trust for my child, with the remainder, of course, to go to the Jewish Community Foundation of Greater Metro West. I'm going to be smart and choose Bank X of Delaware as the trustee, and I'm putting marketable securities into my CRUT. All right. The estate is entitled to an estate tax charitable deduction for the actuarial value of the remainder that's going to pass to the charity upon my child's death, based on my child's age at the time of the death of the participant in this case. I'm using certain assumptions. It's $1 million IRA. I'm saying that based on child's age, that the charitable deduction is about 45% of that, or $450,000 at a 40% estate tax rate, which is what we have today. That's $180,000 savings of estate tax. Now that IRA of $1 million comes into the CRUT, there's no federal income tax on that $1 million. There's no New Jersey income tax on the $1 million because I've got a Delaware trustee and I've got marketable securities. All right. Now, $1 million is now invested and it's going to generate income, but the first $1 million that gets distributed over the many years of the lifetime of child will be coming out as ordinary income because it's coming out of that $1 million of the IRA. The child is receiving distributions quarterly equal to 5%. So in the first year, child gets $50,000. It's ordinary income to child because it came out of the IRA, so to speak. That's the maximum they're paying tax on. And in essence, we've got an installment payment of the IRA to child over a very long period of time, because I couldn't have done this if I gave it to my child. My child under the Secure Act would have had to take it over 10 years. But by putting it into the CRUT, we're going to spread this out over child's lifetime, which is hopefully a lot longer than 10 years. Child is going to get that spread of the income tax. Child is going to get creditor protection, which they would not have gotten if they got it outright. They're going to be protected spendthrift-wise, can't just spend it all because they're just going to get it paid out over time. And in the end, the charity is going to get the leftovers when child dies. We've protected our child from income tax. We've protected the money from estate tax in child's estate. And we've done a wonderful thing both for our family as well as charity. And the only loser is Uncle Sam, and I consider that to be my job.
Thank you, Anita. So we went back to December of 2019, which already felt like a long time ago with the Secure Act. Can you take us back even further to December of 2017? And Jerry referenced this to the Tax Cuts and Jobs Act, and talk a little bit about exemptions and what we can do now and what's on the horizon for the future.
Sure. We are right now with an estate tax exemption of 11.58 million. That's both our gift tax exemption and our estate tax exemption. For the next few years, if Congress does nothing, and we know they're very good at doing nothing, that will continue to rise at CPI, basically, okay? And that'll continue until 2025. At that point, if they do nothing, the exemption will drop back down to what would have been 5 million plus CPI since 2011. That should be neighborhood $6 million, okay? Now, whether we get a new president this year or not, we don't know yet, but we do know before 2026, we will have a new president, okay? So we don't know what's going to happen, whether it will drop to 6 million, will it stay at 12 million, will it go lower than 6 million? We're spending tax dollars hand over fist right now with the PPP loans and all kinds of other things because of our pandemic and other things. So we just don't know what's going to happen to the exemption. So people were very concerned. They're making large gifts, making very large gifts because the exemption is huge right now. And the benefits of making huge gifts are twofold. And of course, the concern was, if I make a really big gift now, if I make a $9 million gift right now, and I don't have to pay any gift tax right now because it's covered by the exemption, if the exemption goes back down to 6 million or even lower, and then I die, is my estate going to have to pay tax on the extra gift I made, the 9 million, higher than the 6 million? And the answer is no. We have a Treasury regulation, thank goodness, that came in last year, or 2 years ago, came in that says, no, there will be no clawback of gifts made larger than the exemption that will be in effect at the time of your death. So the clawback is no longer a concern. But it's even better than that, because not only will that larger gift not be clawed back, but all the future growth on it and all the income on it is also out of the estate. So when I make that gift this year of $9 million, and by the time I die, that $9 million asset is worth $12 million. And all the income that's generated by that asset, none of that is included in my estate. So there still is a real advantage for those who can afford it. for those who can afford it, to make the big gifts. There's even an advantage for some people to borrow, to make large gifts, get that out of the estate, and then have a loan in their estate as a further deduction against their other assets to lower the estate tax further.
Okay, thank you, Anita. So on the subject of loans, Jerry, I'm going to turn the virtual floor over to you to talk about some ways that clients can take advantage of the low interest rate environment that we're in now. So Jerry, take it away.
Okay, thanks, Tamar. Before I get into loans and interest rates, a question for Anita. I don't know if it's been your experience, it's been mine, that the charitable remainder trust that you described so well is a really great opportunity under this new Secure Act not to have to pay the big tax in 10 years and to defer it over the life of a individual, just as it was prior to the Secure Act. My experience with many clients is that they're very interested in everything that you said and the way you said it, but when it gets to paying the remainder interest, and that's going to a charity, while we are all inclined to promote that idea, especially our federation, some clients, that may not be their objective. And I think before setting up a charitable remainder trust, it's been our experience that the client has to be able to tell us that benefiting a charity is one of their objectives, and I would want to encourage them to make that one of their objectives, especially if they have the wherewithal, right? Do you agree? Can't hear you.
Anita, you're muted.
Okay, I agree with you, and I wouldn't even raise it if the client didn't have at least a charitable bent. But what I also say to them is consider the following, that a portion of the unit trust or annuity amount that comes out be taken and invested, I mean invested, in a life insurance policy in an ILET to restore to the family what will go to the charity. Because what the children will say is, but Mom and Dad, what about my kids? My kids will be cheated if I'm getting the unit trust, but then what about my kids? Well, let's set it up in an ILET. So what happens now? Now the children get the unit trust. The grandchildren get the ILET, free of estate tax. The charity gets the remainder. And now everybody gets tax-free money. And now we cheated Uncle Sam even more. And I did an even better job.
Okay. That's what I thought you were going to say. All right, interest rates. Again, I've been doing this for 1 or 2 years, and honestly, I've never seen rates like this, right? The short-term rate of 0.18, the midterm 0.43, and long-term a shade over a point, scheduled to go down even further. And we'll talk about why these interest rates are important in gift and estate tax planning. There's at least 3 or 4 mechanisms that these rates have a significant import. Based on the direction these rates are going, I can't wait to see when a father loans some money to his kid, that the father actually is going to have to pay the kid the interest. That's the way we're going. And in Japan, that's what happens. You want to borrow money from a bank, you have to pay the bank to borrow your own money. Anyway, but let's see how it works in estate planning. We've got 4 different items here: intrafamily loans, grants, charitable lead trusts, and sales to grantor trusts on which a low interest environment creates significantly more opportunities. The simple one, interfamily loans. Take a look at this simple example. We've got here $10 million, an 8-year loan. It's midterm rate of 0.43%. So parents give child $10 million, wealthy parents, obviously, at an annual cost to the heirs of $43,000. They invest it in a stock market, real estate, or business, which with an assumed depreciation of 5%, $500,000 a year. The heir is benefited by $450,000 a year without any gift tax consequences to the parent. If the parent was not interested in making an outright gift of that kind of money today to the child, the loan is an opportunity to say and take a second look down the road and say sometime later, do they want to forgive the loan, forgive it presumably in a year before the exemption might change, the gift tax exemption might change, use the full 11.8 million and not incur any gift tax. So it's a flexible opportunity here. Other loan opportunities from senior generation to lower, the wonderful opportunity to provide capital for businesses owned and operated by lower generation heirs. Businesses now, many have been shut down with the virus. Values are uncertain or diminished. They may need help. Instead of going to the bank, go to dad, parents for a low interest loan. Here's the opportunity to help the family. And another common manner to help the family, children getting married maybe, want to purchase their first family residence. Instead of going to a bank at 2.5% to 3.5% interest, here's an opportunity to loan the kids midterm, long-term, or short-term at these wonderful interest rates that we have here. Okay, so that's loans in a low-interest environment and opportunity to benefit family. Another opportunity is the sale of assets. One of my favorite tools, setting up either a business sale, a sale of real estate, or even marketable securities through an LLC or other entity, okay, to a grantor trust. Take a simple example, and this concept, before we get into the example, is one of the only ways I know of to leverage both the reduction in values on the initial sale, but also to leverage it from a generation skip point of view and have grandchildren get the benefit of lower values and discounted values. So simple example, and there's a full discussion of this in our longer outline, including this Karmazin case that we were involved with a number of years ago, which to my knowledge was the first case where the IRS actually, we went as far as tax court, was settled before it went, before the court decided it, but very favorably settled with the IRS on a sale to a grantor trust. So here's what you get with that. A business asset or real estate or securities, assume again $10 million. Make the assumption it's low basis. So if it was sold outright to a third party, or even on the installment sale, there'd be a significant inherent taxable gain. if we sell it to a grantor trust, and that trust is designed as a generation skip trust, where it's income and principal for first generation children for their lives, and on their death, then for the benefit of the grandchildren, their children. This low basis asset, nobody will incur an income tax on the sale. Why? Because it's going to a grantor trust, and the IRS has announced many years ago in Revenue Ruling 8513, a sale to a grantor trust where the grantor pays the income taxes on the trust earnings is totally disregarded. Not only is there no tax to be paid, they don't even want it reported. So that's a huge benefit. And the fact that, it's only we who are in the estate planning community can say to a client, this is a really good thing for you to sell these assets at a significant discount. Let your children have the benefit of these assets through the trust. And then, parent, you pay the income taxes on whatever the trust earns. Whatever those assets earn, the kids don't pay the income tax. You pay the income tax, parent. Only an estate planner can say that to a client and either not get wrapped in the mouth or create a smile or whatever. But we've been saying it for years, and many clients are quite interested. So no income taxes. It's when you have to worry about if we're going to sell at a discount, is the IRS going to buy the discount? Well, they agree with our discount. Well, we've got a number of cases, the last one being Wandry case. That's the one we like to rely on. You do it with a formula, and we say, I'm not just selling you 10 million or with the reduction, $7 million of an asset, so you can come at me with a $3 million taxable gift. We don't want that. So we structure the sale, and we say we're selling that number of units that equals $7 million in value. We got an appraisal that said it's $7 million. We think it's 100% of everything he owns. But if the IRS doesn't like our discount, okay, then we've sold just the number of units necessary to produce $7 million, and the rest belongs to the parent. The Wandry case was the latest, and that one was favorably determined for the taxpayer. Okay. Let's talk about GRAT planning. This, we just had a little study group session in our firm, which has about 19 offices around the country. And I will tell you that GRATs are very popular, at least with the people in our firm, from coast to coast at this stage of the game. Why? You've got low values. You've got the lemons that we're making the lemonade out of. The low values, the low interest rates, and you combine that with a GRAT. And the concept of a GRAT, for those that haven't worked with it, it's been around 20, 25 years. You're taking an asset, you're putting it into a trust, and you're reserving, the parent who's putting the asset in the trust is reserving an annuity that's equal to the present value of what we're putting in, right? So let's say we do it for a 2-year period, as in the example B2. You can do this for as long as you want and almost as short as you want. So you take back, in the low interest environment, he's taking back over 2 years. If it was $10 million, he gets back $5 million in the first year, plus the very small interest factor. It says 100,000 over here. I think it's even less. compute it based on current interest rates. And then all of the future growth at the end of 2 years goes out to the kids, free from any gift tax. You've made a zero value gift because the value of what you're getting back is equal to the value of what you're putting into it. So we've used these grants with businesses, S corporations, LLCs. We've done them for longer term grants. Doesn't have to be 2 years, do 10 or 15 years. And I always tell my clients, I'm going to do my job. I'm going to get this grant drafted in accordance with the regulations, but you got to promise to do your job. What's that? Got to live, okay? You may not die before the end of the grant term because that will screw it up. It brings it back into the estate. How much is back in the estate is subject to a discussion with the IRS, but it still may be less than the full value, and probably is, but the real value of a grant is for the person who lives the period of time. So we're doing one right now with a 92-year-old gentleman who's been a client of ours for a number of years, and he's just resisted this idea. All he has available is $35 million of liquid assets and a business interest that's worth about another 25 million. So he's got $60 million of assets. And we looked at each other, my partner and I, and we said, we don't think that we want to be the ones that should he pass away, to advise the family that they're going to have to pay out a $25 million check to the order of the IRS 9 months after he dies, without at least trying to get him to benefit by a grant. It's certainly not going to impinge on his living needs. He's going to get back plenty of money over a 2-year period. We calculate that the savings is about 1/3 of the potential tax. What we've done, you can read this in the longer outline. I don't have time to go into details, but we've been successful with an IRS audit on this, where if we've got marketable securities, not just putting the marketable securities into the grant, why not form an LLC first and put non-voting LLC interest in the grant? Get to our appraiser and let him tell us what the discount is. Now, instead of paying him roughly 50% of, say, $10 million each year, the grant is now paying him 50% of the discounted amount. Of say $7 million. So the bottom line, if we get 5% growth on a grant where there's a discount going in, you can get close to 40 to 45% of the initial value in out to the kids without incurring any gift tax. Is this going to work? I went through an audit, and there was no change on the audit. We convinced the auditor that there was a real purpose for doing it. The key in making it successful, don't pay the grant annuity with the business interest. If the business interest is what's owned by the grant, and you use that to pay the annuity, it's a discount going in and it's a discount going back to the grantor, and you get nowhere with it. You have to use other money, and you might say, well, why not just make a distribution from the LLC up to the grant and use that as the other money? We prefer to do it with loans, again, low interest loans from other family entities if they exist, and so to avoid any step transaction issues with the IRS, because they did raise that on our audit, and we convinced them there was not a step transaction because there was loans from a third party. So instead of just 5% growth going out, you can get 40% going out over a 2-year period with that type of a graph. Okay, you gotta live the period in order for it to work. And let's see, the last thing that's on my list here are one of my favorites, Anita. Over the years, she's always loved charitable remainder trusts, and my love has been with charitable lead trusts. It's the reciprocal of a charitable remainder. In the charitable lead trust, it operates identical to a GRAT, okay? It's the same concept. Parent is setting up, use $10 million instead of GRAT, instead of the annuity going back to the grantor each year, the annuity can go out to Federation, right? Each year for, let's say, a 10-year period, and at the end of 10 years, whatever's left, that can go out to the kids. The identical gift tax issues are the same as with a GRAT. It's the same gift. We could zero it out. We could make the gift, design it so enough money goes to the charity over the 10 or 15-year period, whatever we're using. And at the end, it's a zero value gift and there's nothing to tax in the estate, okay? The other thing I like about charitable lead trusts, tomorrow you were supposed to ask me this question in our rehearsal, but it's okay. I'll just answer it. We got a ruling from the IRS, and there's been a number of them since then, to set up a charitable lead trust with, just say, $1 million, right? And the client wants a $1 million deduction this year because he's got high income, okay, in this particular year. We could design this charitable trust as a grantor trust, similar to a grantor trust as in the Parmesan situation where we're selling to a grantor trust. Here, we're giving a third party the power to exchange assets. We went to the IRS for a ruling on that. They ruled that it qualified as a grantor trust, and accordingly, we put $1 million in the first year, and we're paying, let's say, $100,000 out to charities for the 10-year period. We can get a deduction in the first year for $1 million, right? Because it's a grantor trust, and that could save $400,000 of income taxes in the current year. I mean, the tax consequences going forward, but for the client that wants the upfront deduction, there's a way to do it. So that is, want to leave some time for some questions. This is what we got.
Thank you, Jerry. So actually, I'm going to turn the floor. We actually have some fantastic questions, and I know we've gone over time. So I'm going to turn the floor over to Anita for just very few minutes to go over a couple of ways that we can take advantage of depressed values, or let's say uncertain values, depressed values, a couple of more strategies. We'll do a quick version of that because we do have a couple of really good questions. So Anita.
Okay, we'll go real quickly here. Here again, we're talking about, we've got this huge gift tax exemption, and we want to take advantage of that sometimes. We also have our annual exclusion, our $15,000 per donor, per donee per year. Let's think about where we can look at this. So some of our assets are depressed by value because of COVID-19, although the stock market has made a nice bounce back. If we have a second wave of COVID-19, we might, which seems likely, we might have values go down again. But where can we use this? We can use our annual exclusions on outright gifts, of course. We can use it on 2503C trusts for minors. If we have children or grandchildren that we're saving for, whether it's for college or other expenses, we can do that. The HEAT Trust, the Health and Education Exemption Trust for children and grandchildren. It's a great way to use the depressed values. We can get more in there within the annual exclusion, within our exemption, if we've got lower values right now. A GST trust, these are usually multi-generational, and we get more into those trusts within the, not just the annual exclusion, not just the regular estate tax or gift tax exemption, but also the generation skipping tax exemption, which also is currently $11.58 million per donor. The defective grantor trust, and as Jerry had mentioned, the ability of the grantor, as I say, the grantor has the privilege of paying the income tax on the defective grantor trust as, in effect, an addition to the trust by paying the gift tax to pay the income tax for the grantor trust. You, in effect, are making a gift tax-free addition to those trusts, and it's a wonderful way to do that. Gifts of interest in the family business. The family business may have been slightly depressed now because they haven't been able to work. They haven't been able to work or to have their doors open for the last 3 or 4 months, and going forward still may not be doing so much. So the family business value may be lower. Giving an interest in the family business, either outright or in one of these trusts, may be a good time to do that. Similarly, giving interest in the family vacation home, getting a discount value for a partial interest in the family vacation home. Remembering that if I make a gift during life, there's a carryover basis to the donee. If I give that interest upon my death, there's a step up in basis, but the cost of that is potentially an estate tax. So we want to keep that in mind. And I'm going to keep the low basis assets so I can get the step up in basis on death and give away higher basis things, keeping in mind that less than 1/100% of estates pay tax in a time when I've got an $11.58 million exemption and portability of the estate tax exemption, both of which could go away. So we want to keep those things in mind. The carryover basis for gifts, change is new basis on death. Let's use some of our low basis assets and maybe overstuff these gifts and use some of these tools now to get more to our beneficiaries.
Thank you, Anita. That was a great summary. A couple of things. First of all, a poll is going to flash onto your screen about this presentation. If you answer the poll, it will go away from your screen so as not to annoy you. I'm going to ask we have a couple of great questions. So I'll start with a few questions for Anita, and then I'll move over to Jerry. Right now you'll see the poll. So you can answer that, and then we'll do the questions. So Anita, 2 questions for you. Well, really, I'll just give you the questions together. They're separate questions. In terms of charitable remainder trusts, number one, and JCF has a donor advised fund program. We have hundreds of fund holders. We have a terrific DAF program. Can a DAF be a remainder beneficiary of a charitable remainder trust? That's my first question. And the second question that we had is there, given that there is some, I know you love charitable remainder trusts, but since it does require, legal fees and setting it up, et cetera, is there a minimum that makes sense if you're setting up the trust? Like, should it be at least $1 million, 500,000? Like, what's kind of worth it to you in your mind for setting up a charitable remainder trust? So those are the 2 charitable remainder questions. And then on the exemptions, we had a question about whether a new Congress can change that sunset date of 2026 for the huge exemptions. So you can start.
Okay, that's a lot of questions. A DAF
Yes.
is considered a public charity. Yes, it can be a remainder. It can be the remainder beneficiary of a charitable remainder trust. What's the minimum worth it to set up a charitable remainder trust? Well, it depends how expensive an attorney you go to, I suppose, but it also depends who you choose as your trustee. If you choose a bank as a trustee, it's more expensive, obviously, because then there are the annual fees. But there's no requirement that it has to be a bank that is your trustee. A person can be your trustee also. And so, it depends on who you use. I've set up charitable remainder trust for $100,000. There's no minimum requirement. So you have to decide what it's worth. The trust itself doesn't have to be that complex. There are sample forms for CRUTs and CRATs that the IRS has put forward. It all depends on how many bells and whistles you want in the trust. It doesn't have to be that complex, but you do want to go to somebody who specializes in this to make sure you get the right trust, because a trust that is not set up properly, a trust that is not administered properly, doesn't get you any of the tax benefits you're looking for.
Okay, terrific. Thank you.
Was the third question. What was it?
The other question was about the sunset date for the exemptions in 2026. Could a new Congress go back on that?
Congress can always change the current law. They could change the exemption tomorrow. And that's why I always say, I can tell you what the law is today. I cannot tell you what it will be tomorrow.
Okay, thank you. So everyone keep that in mind. You should act now. Okay, two questions for Jerry. Number one, can you give us your thoughts on when and why a GRAT, a grantor retained annuity trust, might be preferable to an intra-family loan and vice versa? Like, as the estate planner, what are you considering when you make that decision? And the second question, we'll do that question first. The second question was if you could expand on the details of the audit regarding the GRAT and the LLC wrapper. I'm not sure if we have time for that second question, but if you could start with the first.
Okay. Let's see. Advantages of the GRAT versus a family loan, these low rate of interest. It really depends what the underlying assets are going to earn. Assuming they're equal, I think it's pretty close. Although with the GRAT, the main benefit is, well, you're getting back the annuity plus very low interest amount. Same thing with a loan. You're getting back the principal. The principal's part of the estate. You don't demand it back. And the low rate of interest. So it's pretty close. I think a child can do more with a loan because trust, the loan can be to a trust with a generation skip aspects, just as a sale on the Carmazine sale to a trust, the same as a loan, taking back a note, and you're getting the benefit of generation skip taxation as well, which you can't get with a GRAT. Okay, GRAT won't work for a generation. So from that point of view, depending on the objectives of the family, the loan might actually work very similar to a GRAT, and in some cases, it's better than the GRAT. Okay.
Can I add one more item?
Yeah, go ahead.
One thing just to keep in mind is the GRAT only works if you outlive it. The loan works immediately.
That's a good point. Okay. Jerry, the next question was about the details of the audit, but I'm, with the GRAT audit that you mentioned, but I'm thinking that since we've kind of gone over our time, I think we should stop here. And I'm going to let that questioner, the guy who asked the question, know that he can contact you. So I don't want to keep anybody longer than we expected. But first of all, thank you so much to Jerry and Anita for this fabulous presentation. Everyone you got in your emails this morning, really detailed outlines from Jerry and Anita that are just totally packed full of information. So I want to thank them so much for all their work in putting this together and presenting. And to everyone else, thank you for joining us, and keep a lookout in your emails for upcoming events that we're having. And if you have any ideas about webinars that we can do that will help you in your professional lives, we are here to serve you. So please email me or Yafa Karp and let us know what we can do for you in the future. And we're looking forward to seeing you on the next webinar. So thank you, everybody.
Thank you.